kind of talk about that as well. How we doing, Blake?
I'm doing good. This is Buffett is kind of a divisive character, surprisingly. I think that there's people that hate him. I think they just outright hate him. It's like the Zuck or the Musk of the previous century, I guess. I mean, we're talking about in the 1960s, 70s, 80s, and 90s. I mean, he's still a pivotal character, but it is odd to me how divisive he is, and they almost want
Yeah,
to take everything he is and throw everything he's talked about out the window because that was back in the 70s.
yeah.
It's fascinating to me to see how emotionally charged Buffett can cause
Well,
people
yeah.
to
I
be.
mean, look, there was 2008, 2009, 2010. I mean, he got a lot of sweetheart deals. I used to joke a former colleague of ours back at TD who liked Warren Buffett, followed him. I'm like, he's the best crony capitalist in the world. And look, I mean, he got a lot of sweetheart deals with the Obama administration. They were on the hook with some of the investments they had, and the Bank of America deal. I mean, look, I mean, he's gotten a lot of recently in the last 10, 15 years. He's got a lot of good deals from government relationships, and so as a function, I don't like him a lot. The fact he had 50% of the Berkshire and Apple doesn't really say a lot. He's mostly a Dow 30 investor, but the guy's raising some cash right now, Blake. I mean, he owns more T-bills than the Federal Reserve. It's kind
You,
of
you know
crazy to think about.
that is super crazy to think about, and I think you made an interesting point there. He's called the Oracle of Omaha. He got this nickname because he was able to see something coming that hadn't come all along yet. But
Yeah.
like you said, if you have 50% Apple, is that really being super forward looking? And when I mean, I would say, well, I'm going to ask this, and let's ask this to everybody out there. If you were to name one stock that you would associate with Buffett and Berkshire, what is the one stock? Because there's actually I've got a list of about six in my head, but I also have one that people don't usually think about. So what is the symbol that you would say? What is the stock symbol that
Good
you would
question.
say is the main one that is the Buffett stock? What is the one that you'd associate most closely with Warren Buffett?
SSS has got Oxy. That's what I was going to think of.
That yeah, and Oxy would be one that that's the one that
Coke,
I have personal feelings against. Um,
Norfolk Southern.
Yeah, nice, nice. Coke, there's another Coke. Apple, we just talked about that one.
And then Norfolk
Oh,
Southern. I mean, that's another one, right? I'm like, we shut down pipelines and we let Buffett ship it everywhere, right? On trains. I'm like, that was another one, right? Like bailout for Buffett.
yeah, and the
Insurance, yeah.
insurance
Geico.
company and Geico's, I think Geico for me is the biggest one that people forget. I mean, part of his oracle-ishness is really that he bought Geico when it was dirt cheap
Mm-hmm.
and happened to be right there when the lizard takes control of the world. And and so Geico is a big one for what they're successful in producing. But yeah, Oxy and Geico, Coca-Cola. Um, I no one mentioned McDonald's. Got J&J,
Yeah.
but remember
You know,
he likes to have his McDonald's and his Coke every day.
are you talking about me or what?
Yeah. Oh wait, we got distracted here. Sorry. Now we're talking about your favorites.
It's one of those things that I'm like, I mean, look, the thing about it, I mean, and I think Apple was one that was sneaky for people, right? That 50% of Berkshire up until recently was in Apple. And it's like, it's kind of like the Seinfeld episode where it's like, at what point do you just back up and not look, right? And that's kind of where Berkshire was or has been. I mean, I think it's still 30% of Berkshire's in Apple or somewhere around there. They've been reducing it, which is an indication they're building cash, they're investing in T-bills, they're parking money right now. But it's like, at what point do you just back up and say 50% Apple, no matter what, right? Okay, now we're kind of, but it's kind of those things. It's like you get old. People are saying he's not in the day to day, but again, it's just kind of those things. You just kind of, I'm going backing up. I'm not looking. You better watch out. That's kind of like the Apple trade to me that they've had it when they had 50% of Berkshire and Apple. That was kind of an interesting phenomenon.
Yeah, and do you remember that Brian Regan comedy special that, he did the I before E, and he's I before E except after C, except for words and neighbors and away and weekends and holidays and all throughout May, and you'll always be wrong no matter what you say. So
Yeah.
so but at the very beginning it is I before E always. And that's kind of what it's become, right? It's
Yeah.
oil stocks, insurance companies, Apple.
Yeah.
And he's kind of one of his favorite sayings, I like to buy my stocks like I buy my socks, on sale and half price. And so this building of this war chest, if you might want to think of it that way, of cash, historically has been so that when the market does correct dramatically, that they're buying everything at a super deep discount. But I think you're right. I think he's not involved in the day to day. I think we're seeing that fade. And so maybe this going into cash is more of a transition away from Buffett entirely, as Berkshire is now kind of in its own little world, and it's and going to be in the hands completely of other people. I
Yeah.
don't know.
So
I started thinking about that.
yeah. So we're kind of providing a little background on Buffett here, but there is something called the Buffett indicator. And look, I mean, there's different indicators that kind of look at market valuation for the market as a whole, and this is one of them. And it's not great in terms of the where we're at right now in terms of valuation.
And so this is I did this. It's total market capitalization of the U.S. stock market divided by GDP, and so we're at about 197%. And we've got this lovely indicator to show you how bad that is. Now, for those of you that don't understand why we'd be looking at this, market capitalization says, show me all the current market selling value of every publicly traded stock. But the other thing we're not accounting for is private equities and stocks that aren't on there. So can you imagine GDP is supposed to be everything everybody produces?
Mm-hmm.
Now, if you were to say, if we take everything everybody produces and pile it up into a pile and then compare that to GDP, which is supposedly what we did produce, and compare that to total market value of just the publicly traded stocks, we're saying that we're trading at 200%, two standard deviations of that value.
Yeah.
So we're worth twice as much. And you can see where we sharply reverse. And I've got a different chart for this as well here in a minute. But I forgot to show you this one, Brandon. I actually got this one.
Uh-huh.
And this is including public and private equities, roughly. And we're at 300%.
Yeah. And when you look at that standard deviation kind of range,
Mm-hmm.
you also have to understand the mean, the average is increasing. And that's not good either, right? The mean that we're
No.
paying more and more for stocks, right? Than we are again, we're increasingly paying more and more for stocks relative to our GDP. And even about that rising mean, we're at the two standard deviation level. Okay. And so the idea is that we are extreme in a lot of different respects, not just in the deviation about the mean, but also given the fact the mean has been rising. And you're right. I'm like, we're talking about we're drawing a lot of value from a relatively smaller amount of GDP, not smaller from 10 years ago, but the percentage, right, that we're paying
Mm-hmm.
for stocks relative to GDP, private and public and combined, right?
Yeah. And you're, this one really quickly as well. I think this one, if you flattened out so it wasn't really off that curve, you can see this is where we hit in the 60s and 70s. This is where we hit in 2001. We actually hit not even barely past the midpoint
Yeah.
when we had the 2008 crisis. But we're all the way up here. And we've done double, triple tops like we did in the 60s and 70s. And the correlated material would be inflation.
Yeah.
So if we're going to hit there and hit there, inflation, I believe, caused it to spike again in those valuations.
Yeah,
But
and even when you look at 2020, you think, oh, we market was down 36% or something like that. I'm like, oh yeah, we corrected back to this was a multi-generational buying opportunity. Well, the reality is we did not even get that undervalued in 2020. The Fed just stepped in and provided about $4.5–5 trillion in stimulus. And we sent out a bunch of stimulus checks, government spending, everything exploded. And yes, these big companies benefited, particularly the Magnificent Seven, right? The
mm-hmm.
trade that we're seeing unwind currently with the carry trade flipping around, NVIDIA. These companies were born, Apple was born out of the stimulative efforts of the Fed and the incredible spending from the federal government that spanned two administrations. And so so again, it's a nonpartisan issue, but the point is we pumped a lot of money in the system to be able to push valuations higher. And yes, we're at extreme levels. And so if you were to forecast based on this current level in the Buffett indicator, a year from now, we're looking at no expected return. You start to push it out 10 years from now using other measures, we might be looking at a 10-year return of maybe minus 6%. If you look at GDP to gross value added.
I couldn't get this to pop out. I've tried. Didn't want to embed into another one, but this is predicted and actual stock market returns from previous times, and you can see that we're looking through here, and yeah, we're this green line way down here. This is the 20-year average expected return, and we're saying that over the next 20 years, based off where we're kind of at as of July 30th, we're expecting a negative 4% per year average return, possibly for the next 20 years.
Yeah. And that's the point, is that when you provide a lot of stimulus, right? When you borrow a lot of money, you're basically pulling from the future back to the present. Now, it's possible the market may return a lot if the dollar is going to tank, right? So that's where a lot of our returns have happened in the last 30 years, is because we've devalued our currency to a point where the market looks like it's gone up. We have that mirage that we're adding value to the market when we're really just adding price. When the purchasing power of the market today versus 1997, where we really started to put in and engage in the Fed put, we're really not seeing a lot of real value added to the market. You're not buying any more. If you were to invest in the S&P back in 1997 and sell that investment today, and you figure, hey, I'm going to go buy a bigger home because the market's returns have been so great, the reality is the home you're buying today is probably less than what you're buying in 1997.
Yeah,
it's just one of those things. The purchasing power of the market is diminished because of the devaluation of the dollar.
Yeah, and last week we talked about the returns on the S&P, and I think there's I sent you an email that someone is questioning us on it, and we were not by any stretch of the imagination saying that it was a positive return. Even if you had inflation adjusted, that's still not the big picture, because everybody paid taxes on that as well. So your net in pocket and purchasing power is horrendous.
Yeah.
It's
so
just
index investing is dead. I'm like, look, if you index invested the last 30 years, you're not up a whole lot, right? I'm like, this has not been a very successful venture. The whole behavioral finance, FAMA and French. The reality is inflation has eroded your returns substantially. And so investing in individual stocks has been the way to go. Investing in Apple over that period performed phenomenally well. So again, as we think about investments and where we put our money, we're talking about the market as a whole. But just like Buffett, you got to find opportunities that you expect to outperform the market. And right now, they're not seeing a whole lot. Thus, the $200+ billion in cash and holding more T-bills than the Treasury. Than the Federal Reserve.
Yeah. So if they're buying into that, does that create an acceleration? Do you think that's actually increasing the price? Really, is Buffett buying so many T-bills that we're buying into? And I need to shorten this up, obviously, if we're doing T-bills. But we'll use ZN and ZF for just a minute. Do you think that's creating a artificial demand if they're buying it and buying more than the Federal Reserve?
Well, I mean, the Treasury put out, what about since last November, at $2 trillion in T-bills. So probably not. But the reality is, what is he banking on? He's banking on the Fed to cut rates. Okay. If you're buying short-term debt, or you're going to take the bonds as they mature and then redeploy those. But yeah, I mean, right now, I mean, the Fed is poised to cut. And I've been talking now for a number of weeks. Hey, something like SHY, if you're looking at park stuff, there's a little bit of risk there, but not a lot. There's a decent amount of upside if you are correct. I'm like, you might get 5%, just on the yield, plus you might get another 5% just on the appreciation if the Fed starts to cut rates. And so again, there's some profit opportunity in the bond market there, and maybe that's what he's looking at. But it certainly says, look, the investment opportunities in the market are less, the expected return of the market is less. And so, look, I mean, this is a point where I'm not saying you have to sell everything, but in the near term, this is a point where you're probably looking to probably hedge that downside because we're still not out of the woods on the sell off from the last few weeks.
Yeah, and you bring up the point that that he hasn't probably caused it to move. So if someone asks, what if he sells it all off to buy other things? When you don't move that size of a you don't move a train car just
Yeah.
by going and giving it a shove. Okay, this we're talking about a massive amount. It's going to take a lot of time for that to be able to kick in and happen. But in addition to that, I would say that you have the concept and the view that even if they're selling, if the Fed is going into buying mode and rate cutting mode, this is necessary to drive it higher. It will go higher. You cannot have the prices have to go higher if the Fed is actually moving interest rates, because the existing bonds, the existing treasuries, the existing notes the bills have to adjust their price according to the other, so that the yield matches the new release of new bonds on notes. So I kind of covered that in the main room, and we can do that at another time. But if they raise rates, then the demand for those new ones go up and the demand for the existing goes down. So now if they cut rates, the demand for the new stuff is lower and the demand for the existing stuff goes higher, and it drives the price higher. And you'll find that the equilibrium is found with existing versus new issues. And
Yeah.
that's it is necessary. It will happen.
Yeah, and Neurobeanie, Dr. Doom published a paper. I kind of talked a couple weeks ago after watching some from Kyle Bass, but the idea is that the Treasury last November shifted, right, their focus from selling a breadth of different durations, right, maturities, short-term T-bills, notes, and bonds. They exclusively went towards T-bills to the tune of about $2 trillion, and that had an effect of potentially about a 1% rate cut in the Fed funds rate by providing that amount of liquidity, that short-term debt being bought and gobbled up, used as collateral to then what, to lever that up. And so we've seen that, right? So the idea is that, look, I mean, Buffett's kind of following the Treasury and Janet Yellen by changing the composition of their debt issuance, basically saying she thinks their Fed's going to cut rates too. So we're kind of leading all this stuff into the idea of the Fed cutting rates. And why is the Fed cutting rates right now? Again, if you believe that it's about inflation moderating, okay, maybe you got a point, but the reality is this is a point typically in the cycle where Fed rate cuts are about weakness. Now, the retail sales this week didn't necessarily say weakness, but the idea is that we're basically seeing the economy weakening and market valuations high. So getting back to Buffett, why not, right? Front run the Fed, follow the Treasury, and then at some point here, probably look to deploy if we see a market correction. Look, the Treasury's banking on a market correction and a current contraction in the economy. That's why they're expecting the Fed to cut rates and allowing to roll this debt over at lower rates in the future. So we'll see what happens. They played a delay tactic, and maybe it'll play out positively for them. But they paid about $30 billion in additional interest payments the Treasury did by making this gamble of issuing T-bills with an expectation the Fed's going to cut rates and roll it over at lower rates. But Blake, right now, I mean, where the market stands right now, is this a FOMO or a NOMO? Meaning that we see the nice rally off the lows, we have a record decline in the VIX, right? Just boom, from like 65, we're now down to 15, 16 here. It has the near-term boost this has had to the market. Is this a point to start to get FOMO, fear of missing out, putting your capital out there, or is this to basically play the Buffett approach of NOMO and going to cash a little bit here, or hedging the downside? What is your take?
Well, so, and I think we can get a take. I'm a big believer in behavioral economics. Like that Eugene Fama and others have talked quite a bit about. And
I
so
think they're
my view,
communists, but that's okay.
yeah, behavioral economics. And that if I ask the question, and this is about, and Mariano's talking about a video from yesterday as well, the one of the things I commented on was that the behaviors of the consumer I don't care that retail sales were high. If you look at the data, that retail sales in Walmart saying, hey, it hasn't hit our customers yet. Walmart isn't the place for discretionary income spending. Even though they have TVs and other things like that, they're not their store isn't, their revenues aren't based off of consumer discretionary excess. And so they haven't seen the retail traders or the consumers get hit yet. And you look at the retail sales and say, yeah, it's up 1%, but we are at record highs. We're at $1,068,000,000,000 of consumer debt and revolving credit. And so we're at record highs of debt. And I don't see that as the same as FOMO. I think you have add that to the fact that we're leveraged up to the hilt, and the people that are investing in the market, you and I, all of the Theo traders, this was shock and awe, VIX high, and the pullback. I think people are a little bit more nervous. I'm looking for rollovers at lower highs as far as consumer discretionary, as far as what the consumer is really going to drive that edge of the market. And you look at Coca-Cola and say it's way up at the top. Well, Coca-Cola and Philip Morris and Altria, all of these are considered staples.
Yeah.
They're not considered the excess. And they take something like Lulu, and we're not buying this kind of stuff. So the money is not being spent there and the market is not pricing. So I don't think it's FOMO this time. I don't think the VIX spiking is FOMO. I think it is NOMO. I think we're going to be careful, and I think we're going to be following Buffett in many ways into that safety investment.
Yeah. Back in on June 18th, I walked through, hey, look, the volatility markets are signaling a 5 to 10% correction in the market within the next 3 to 4 weeks. It took a little bit longer. We walked through a hedge, an atomic hedge or a variation of the atomic hedge, selling call verticals, buying puts. And then on when we sold off on the 5th of August, because with an August expiration, we talked about rolling those puts. So the idea is you went from basically taking some profits, hedging, taking your delta or your exposure to the market, you're having it by virtue of taking profits and hedging. And then all of a sudden the market sells off and those puts go in the money. And all of a sudden your exposure to the market, your delta goes from positive to negative. And then on the 5th, you roll that put and you roll it out of the money, and all of a sudden your delta just increases to about 50% of what it was, 50% of what it was in June. That's how you add exposure to the market, right? Do you rush out there and buy stuff at the lows? And definitely after we've had a very historic move lower in the VIX in the last couple weeks, pop and drop. Now we're at this point where I walked through yesterday, and today I'm going to walk through how to hedge at current levels. Whereas yesterday we talked about the results of the roll and the management of the hedges. This is a point where you start to temper some of those expectations because the VIX has come down sharply. The back month volatility is still elevated. So we're looking at volatility to expand in the coming weeks. So we may be looking at another 5 to 10% pullback. So again, you up your delta by rolling your hedges. Maybe you took some longs, but right now it's time to kind of consider running for cover a little bit in case the market pulls back and retests lows from its current level.
Hey, really quickly, someone asked about J9 asked about whether NOMO, and I was assuming that meant no more, not
that's
there's no
not
acronym.
Hideo, not Hideo NOMO. We're not talking about pitching.
No, I don't even know where that is. You're talking sports.
So NOMO meaning no more. Meaning the idea is
no
that
more.
Hey,
okay.
may have taken a little bit of risk in this run, but right now it's time to probably temper some of those near-term expectations. Thus NOMO.
I thought that was the case. FOMO, fear of missing out. NOMO, not going to do it. NOMO.
This is not the time to screen Nandeska, right? Nandeska, it's a Japanese phrase.
日本語わかりません。
私のシャツは青いです。My shirt is blue. I got it. No.
All right. So here we go. Let's go through some of our bears and bulls. I know we're running on time because we spend a lot of time talking about Buffett. But Walmart is one that made it to both my bullish list and your bearish list. But you have an interesting reason why it made it to your bearish list. And I think it's kind of fascinating. For me, even with the gap, we've got any type of a pullback and a bounce I'm interested in. So I'm going to leave that at that. But why do you like Walmart as a bearish position, but it was also on your bullish list?
Well, so, look, so I usually have 3 criteria, right? On earnings, you beat, you raise, and the stock price goes up. So in those 3, Walmart hit yesterday, right? So again, near term might be $80. But we're also talking about a stock that by historical standards is very overvalued. And so when you talk about options and volatility skew, playing the downside from a spread trading perspective is relatively cheap. And so the ideas we walked through yesterday, basically buying a downside put vertical spread, which is priced pretty cheaply right now, and looking for just part of that gap to close to about 71. However, talking out of both sides of my mouth, volatility collapsed with that. We're talking about very, very low volatility levels. So we also showed a call spread that was not very poorly priced. I mean, the skew is very minimal about 29 days out yesterday. So he said, look, you could buy a call spread, you could buy a put spread here. The put spread's priced better, but the call spread's not bad. And you could even do both because the vol's so low and play whack-a-mole. Market goes up, take it off, market falls in the next 40 something days. You're out if we get down towards 71 again. But I do like the downside a little bit more than the upside here. But I think we could go to 80 in the coming couple of months here. But Walmart is historically very overvalued.
Okay, and I'm purely trading it from the idea that, I'm big on sector rotation and believe that markets will still find a place to put money, we've seen, even if they're highly overvalued. See Tesla when it was 1,000 PE, right? Now, I'm not saying Walmart will ever reach that because it's not a tech stock, but there's still a rotation of money. So that's why I'm sticking with it. I just want to see how far it's going to pull back. I really don't think we'll fill the gap. I think we might pull back to 71 before you get a bounce, and then I'll be stepping into that one as well.
So that's what the put vertical plays, basically retesting prior high. But but looking at Walmart's margins, you think about the valuation being extreme for Walmart by historical standards, record highs in terms of like price to book, price to sales. And at the same time, it's like, their margins are like 2.8%. So they take in $1 revenue, they're keeping 2.8 cents of that. And with all the talk of price gouging, I'm like, I'm sorry, Walmart's not price gouging. Their
Yeah,
margins are
Walmart's not.
2.8%,
They're
baby.
vendors maybe, but they are not.
Yeah.
They're the
But
people
they're
that are
squeezing
selling
them
to.
too. I'm like,
Yeah.
they're trying to get the absolute bottom of the barrel pricing. But anyway.
I'm going to show these really quick because we're not going to
Yeah,
get to
let's
all of
go.
them, and I want to get to some of anyone else's that would like to throw those in. But Walmart and Macy's are primarily the ones I was looking at. Apple still made my list, which I almost threw up into my mouth when I typed it. I want to look at your gold and FCX though. Is this part of what we're talking about today? In that, if they're going to cut, are we betting?
Yeah.
Yeah, GLD, right?
It's
FCX
just a
and
play
GLD.
on the idea that the dollar diminishes. So we talked about on Monday bullish option activity in FCX. I talked about in the video, I believe, on the as well. So we had a couple of big trades this week in FCX. Gold looking for a breakout as well here on a weaker dollar, which is not a certainty, right? Market starts to swoon, the dollar may strengthen, gold may break out to the downside, but we're kind of forming a little bit of a symmetrical triangle in gold. FCX had a bit of a breakout this week. So again, just looking to get back to retracement levels. But again, we had option activity on Monday and then again on Wednesday in FCX. We got this or Thursday in FCX. We got a nice little breakout here. So just looking to get back to maybe 1/3, 1/2 retracement in FCX of the downtrend.
You
K-Web, I
want to
like K-Web too for weak
Okay,
dollar.
web. I was going to say, so it's the kind of the weak dollar play that, and even like um, Dunk was saying that, if the Fed comes and bails anyone out, if there's defaults and they bail anyone out, the banks get in trouble, anyone out, all of that will feed into a weaker dollar. And so
Yeah.
I think that the weak dollar plays could certainly be on the table. And at that point, even then, Buffett's leveraging not completely into cash, he's leveraging the bonds. It's still that same idea. I don't think he is blindly saying, I think the dollar is safe. I think he's expecting a short-term disinflation type of situation in the dollar first, because that has to happen for assets prices to come down. And then when they come in to save the day, then he's going to pull all that cash out of his accounts and give it to the market somewhere as he moves away from the weakening dollar. At
And
least if
maybe get
history
another little
reproves.
sweetheart deal with the next administration, whoever's in there, because
Yeah. Why not? Why don't you just give me, why don't you bail my insurance company out?
and
The
that helps me keep my cash, so then I can lend that money back to you and for a nice premium.
Yeah, exactly. I'm calling the top on T-Mobile. I know it's one of the one that's is super bullish, and this goes kind of contrary to the way I've looked at the market. But in a microcosm, I drive by two T-Mobiles or go by two T-Mobiles, and it seems as though they have really ramped up the number of workers without seeing ramp up of the number of people showing up to their store or their kiosk or. Um, T-Mobile and the phone companies, they are, I think, stretched, and this is one of the areas that you're going to see people trying to reduce the cost. Maybe Mint Mobile is going to do better, so Ryan Reynolds' company will do better in that situation. But I do think this is an extreme level, and it is treated like a consumer staple. But where do they make their money? It's are we going to see a whole bunch of new phones being sold, and are we going to see the recovery of the consumer being displayed here with new Apple, because they have a new phone being launched or announced, I guess, this week. Apple does. And is everybody going to go buy their phone from T-Mobile? That's usually where they buy them. They buy them from their own.
So subscriber growth. I mean, Verizon had a poor day yesterday, nice little downturn. You know, could see 38, 38.75 the next few days here. So we're at $40 right now. So yeah, the space is looking like we're wanting to pull back, which again,
Yeah.
I think this is a time where if you're looking at risk, you're adding it on the bearish side, given where we're at right now.
Yeah. And I was looking at this, and yes, it's the subscriber, the mobile phones, the plans that are here. Are people going to increase the number of plans? Or are we just pricing in? And I think this is what really has gone on here is we're pricing in their increased price coverage. Yeah. They've increased the cost of their subscription. And I believe that is also going to see people looking to find substitutes, including, like we said, the Mint Mobile, the Crickets, the things like that.
So Don says that Mint Mobile was bought by T-Mobile. So
I
didn't realize that. Ryan
I did
Reynolds
not
is a
realize.
sellout.
He is. Where are you, Ryan Reynolds?
The billionaire.
Yeah,
She made some
billionaire.
smart decisions.
He's made some very smart decisions, and apparently selling Mint Mobile to T-Mobile for a fortune probably was not a bad decision either. So, all right. Do you want to hit? We already hit Walmart. Do you want to hit Halliburton? Do you want to talk anyone else?
Yeah. So I mean,
we...
oil's taking on the nose today. I mean, again, this is where we're still hashing out, and this is the confusion in the market right now. We're hashing out: are we in a growth trajectory, or are we not? Right? Are we going lower? The Fed is cutting rates because of weakness. Halliburton's setting up in a nice bear flag formation. We already had the breakout. The next leg lower, there was bearish option activity a couple of days ago. So looking for a breakout to the downside from this bear flag that is kind of trading in without the confirmation. But again, you can take a nice little bearish spread, buying the higher strike, selling the lower strike, even in out like a 32, 30, 30 strike, put vertical out 30, 45 days, but capitalize on just a downside breakout here.
All right. Well, and I thought this would be interesting with the marathon as well. Very fascinating to see how aggressive this is growing while you have Halliburton and some of the others dropping down, including Oxy.
So Halliburton has its own issues that are, led to the downside. Schlumberger's performed relatively better, but still sold off recently. But I like oil at this point. Again, we're still in backwardation. The risk is the upside. We're getting hit today on the oil front. Oil prices down, but supplies are below 5-year lows. So I mean, we're in a very tight supply market for oil. So producers might be a reasonable. Integrated companies like more integrated companies like MRO.
Yeah, MRO was on my bullish list. I really liked the bounce and breakout there too.
Yeah, so I like Exxon, but Halliburton had the negative of its earnings and some of the suppression on the service side of it.
All right, we are out of time, frankly. We've got to get out of the way for Don to take over here in about 3 minutes, and Don's in here lurking about.
He's watching and judging. So for those who know Don's always in the background,
always watching,
and his comment, watching and judging.
That's right. Always watching and judging. Any parting comments? I know that we spent a little more time talking about the Buffett indicator and the reason why the valuations are not what we think they are in the global scale or the economic view. But any parting comments?
Well, look, I mean, an overvalued market can always get more overvalued, right? We know that. But this is a point where in the near term, I think the crush and volatility, especially the last couple of days, have pushed the market higher. We're kind of at a point, a stress point where we boosted up as probably as far as we're going to get. I can't see the VIX going a lot lower here. And so I think this is a point where, again, you probably take some profits. You probably look to hedge some risk, which I'm going to talk about today during my session, how to hedge this point for a 5 to 10% pullback from our current level. But I think you got to be aware of that. And look, if we're unwinding towards a recession, the sell-off could be much bigger. It could be short term, could be longer term. That we don't know, but we're talking about very extreme market conditions.
Yeah, and that's be careful and look for safety. I mean, there's still growth. Buffett sees it in bonds, and I think you will likely see that if the Fed does cut, and we're still pricing in 3 cuts. We unwound a little bit, but we're still pricing in 3 cuts, maybe 4, but 3. All right. Have a great one, everybody. We'll see some of you in the main room in a little bit, and here we'll jump off, and Don will take over from here. Have a great day, everybody, and if not, have a great weekend.